Hi, I'm Danny Ecker with your Chicago Business Today midday report. Groupon stock was down about 10% at just over $21 a share this morning following its first public financial report yesterday. The company lost $42.7 million in the fourth quarter, despite revenues beating analyst expectations. It's more evidence for analysts trying to gauge Groupon's long-term growth potential. And for more, we bring in Crain's senior reporter, John Pletz. John, obviously stockholder perception was down, at least in the short term for this. What did you take from the report, and what are analysts saying in terms of signs of improvement and growth here?
Well, investors were expecting them to post a profit, but they didn't. But they put up some strong growth numbers, and that's really what the analysts were paying attention to. They were able to get a little bit of control on expenses. Marketing spending was down, and the revenue's up, so they continue to grow.
One of the biggest concerns after the IPO was the overwhelming marketing cost, the cost of getting new subscribers. Those costs are way down, but what kind of indication do we have that they're not going to be getting in the way of profitability moving forward?
Well, they're still growing, so that's a good sign that they're still able to put up pretty strong revenue growth, even as they bring that marketing expense down. As that revenue amount gets a lot higher, obviously marketing is going to be less of the pie. But it's really hard to tell exactly where the profitability is going to shake out, and partly that's because you don't know some of the previous metrics that they had thrown out there, total subscribers, number of Groupons sold, things like that. They're not disclosing now, so it's a little hard to gauge, and that's what really the analysts are waiting to see as things go forward. It looks like things are headed in the right direction, but you really can't tell how.
Groupon expecting to top revenue estimates again this quarter, but it's tough to find the right measurement for growth. All right, John, thanks for the insight.
Thanks.
Elsewhere today, PepsiCo is cutting about 150 local jobs as a part of a global restructuring. That's about 8% of its Chicago workforce, and comes as the company battles high commodity costs and is looking to boost advertising in North America. About 1,800 people currently work at the West Loop headquarters of Pepsi's Quaker Oats, Gatorade, and Tropicana brands, but no word yet on specific jobs that'll be eliminated. The company is cutting 3% of its entire workforce and says it'll help save an additional $1.5 billion by 2014. And CME Group is in the final stages of a deal to sell a major portion of the Chicago Board of Trade building. A joint venture led by Glenstar Properties is reportedly buying 2 of the 3 CBOT towers, about 1.4 million square feet, for a price in the range of $150 to $180 million. The building took a major hit with the recent collapse of MF Global, one of its largest tenants. Sources say the deal is set to close in the first half of this year. Glenstar owns several other Chicago buildings as well, including the 1.5 million square foot office and condo building at 55 East Monroe. And that's what's happening in Chicago business today. For more on the local business scene, stick with chicagobusiness.com. Thanks for watching. We'll see you tomorrow.